What's up, party people? How are y'all doing? Let's get that music on out of here. As much as I love me some good AC/DC. Let's pull up the chat box here. I got some folks coming in from the waiting room. All right. Wait, no music again? God dang it. I think I hit the share button, Carl. Well, now we're just gonna have to listen to some music, and we're going to have to, let's listen to some music while these folks are coming in from the waiting room. I think that's what we're gonna have to do. Right? This is what I was jamming to. You thought I was just having a stroke or something. And I'm just over here doing this. And it's just like, what's wrong with that kid? Now we're talking. You can hear that, right? There we go. That's what you should have been hearing. Sorry about that. 2 times in one day. What is it, a full moon or something? All right. So, what's up, Ryan? That's right. Rock and roll. Man, Ace Frehley, huh? Did you guys hear he passed away today? Ace Frehley from Kiss. Pretty sudden too, I think. Was never a big Kiss fan, but they made an impact. So here we are, Stocks on the Rocks. My name is Corey Lane. If we haven't met before, a lot of you we meet several times a week in our trading rooms here at Traders Army. But if I haven't met you before, nice to meet you. I host this Stocks on the Rocks open office hours Q&A, happy hour, whatever you want to call it. Happy hour it is. There it is. Every other Thursday, which gives us the chance to just kind of banter about stuff. Unlike being in a trading room, because we have 8 trading rooms a week at Traders Army. Some are focused on options and stocks, some are focused on futures, and some are focused on crypto. Some are focused on longer term investing, what we call wealth essentials. And so I always come pre-planned. We always come pre-planned with things to look at and trade and talk about. Here, I come pre-planned with nothing. This is 100%, the length of this session is 100% relied on you guys stimulating the conversation, asking questions, sharing successes, sharing not so good successes, right? Bring up your charts. Let's look at some of your charts. Let's look at some of your trades that you're in. Just ask anything, related to stocks, options, futures, trading in general, investing in general, or whatever you want. Sometimes we'll talk for 20 minutes about nothing that has to do with trading. This is open office hours, happy hour. Just going to hang out for the next anywhere between 5 minutes, which is my introduction here, to 1 hour. And sometimes we go a little bit over the hour, and we never go under the hour. Let's put it that way. You guys are always really good about that. So that's what this is. We are recording these sessions, so you can go back as a pro member of Traders Army. You can, wrong window. You can just go to your Student Resources Pro Member Community Lobby and find Stocks on the Rocks office hours down here next to all your other trading room recordings. Or you can go to YouTube, because I do put these on YouTube. These are open to the public. We send out an email to our entire mailing list, our whole database, and say, hey, join us if you want. It's free. So sometimes we get extra folks in here that we don't recognize. And so if you're one of those people, thanks for joining us. Everybody's always welcome. Invite your friends, your family, your enemies, whoever you want to invite. The more the merrier. As far as how do you ask your questions, you can ask questions through the chat box. I'll talk about Carl, I see you there. Can we talk about the VIX hedge in a second? So yes, we will. A trade that we have on from one of the trading rooms. You can say, hey, can I turn my microphone on? Can I share my screen? Feel free. You don't have to, but sometimes folks will turn their cameras on and we can see each other even. You can see me. You don't have to turn your camera on, but this is the environment where if you want to, you're certainly welcome to. All I ask is, because this is open to the public, that we behave like adults. We don't do anything that's going to trigger me having to pull the recording because there was just some not so good behavior. We opened things to the public in the past, and we've had some folks, get on and just, I mean, you've seen those back in COVID when people were jumping on people's Zooms and doing very, very, very disgusting stuff. So we don't want that, because then I won't open it to the public and I won't post the recordings. So yeah, as long as we're behaving and we're being cool, then we'll you were in one of those, Ariel? Oh yeah. Yeah, those were fun. But Carl, yeah, let's talk about our VIX trade. We'll go into there first. I'll bring up my chart and then you can tell me what kind of questions we have. So VIX up 22% today. That's a big spike. Okay, so what kind of questions you got on that?
Well, it was only showing a profit of a reward of about $40, I believe.
Okay.
And we were risking 100 when it hit the 25.
Yeah, what I think is happening here, yeah, and we're up at 25, so that, oh, I'm like, where's my position? There it is.
I mean, I
Um,
understand that what is it? It's based off of the VIX futures, isn't it? In
it,
Thinkorswim.
it is based off of VIX futures, right? So VIX futures are at 24. So it's not above. So the VIX futures are not causing the option spread to be in the money, but the VIX is. And so this is based off of VIX futures, which still rose to 24 points. It got above almost right to 25 and then backed off. That's what we're seeing right now. Looks like after hours. Um, but it's not exactly
Well, our first target we said was 25, right?
yeah. And I think what's happening, I mean, right now this looks like it's in a positive theta position. Negative vega. So what does that mean? That means if volatility is rising on the VIX, that's a negative. So while theta is helping, and of course delta should be helping as well, because it's moving in our favor. I think volatility rising on the VIX might be part of the problem, right? So when volatility rises and you have a negative vega position, that's going to pull money away from the positive theta or the positive delta. So I think that's what's going on here with this, which does, unless you get a big, big spike, sometimes that does hurt the potential profit in the VIX options. Because what's happening is all of these options on VIX are constantly being let's change this one over to implied volatility. All of these options are constantly being readjusted, the bid price and ask price. So the implied volatility on these options are being adjusted so that people don't make money very easily. What I mean by that is I think everybody who trades ever knows that when the VIX is low, the market has a tendency of falling, therefore VIX is going to rise. And if you know that the VIX is going to rise when the market falls, then theoretically, if the market makers didn't adjust for that or plan for that, they would let us buy really cheap options when the VIX is low and be able to sell really expensive options when the VIX is high. But since everybody knows that's how the VIX acts, market makers inflate call prices a lot when the VIX is low. And as the VIX goes higher, they'll deflate call options and inflate put options on the VIX. So I think that's what's hurting this position right now, and not hurting it. I mean, it's up $50, but it should be up a lot more if not for this rising volatility in the VIX options. Does that make sense, Carl?
Okay, yeah, it does actually. Because I thought it
Uh,
was based on the VIX futures, the prices, but on the
well,
Thinkorswim.
it's all that's the case for every platform. It's not even Thinkorswim. Every
Okay.
every every platform is like that. So, um, and so here we're not seeing volatility rise all that much, but there's separate options on VIX futures, right? But we are seeing that volatility inflation on those VIX deflation on those VIX calls, inflation on the VIX puts. So Yeah, Ariel mentions I find UVXY. I don't think I've ever traded UVXY, but I'm kind of getting a little bit tired of the VIX hedge. I mean, it's worked out in the past, enough times for me to not completely abandoned it. But there's been times where it's a head scratcher. It's like, man, that was a heck of a move in the VIX, and yet we're just a little bit profitable on this option trade. And yeah, I'm kind of getting a little bit tired of that. So UVXY, what do you find to be better about that?
Yeah, because when it hit 25 this afternoon, I was only ahead $40. We were risking
Yeah,
100 and it was only up 40. And I thought, nah,
yeah.
I'll hold
Yeah,
on
it's
to it.
yeah, I'm gonna hold on to it too. And I'm actually, so this is Ultra VIX short-term future. So this is leveraged. Um, but so Ariel bought the October 17. So you just bought like a 2-day option. 12 by 15. Okay. And that's when UVXY was probably around at the money, 12. Oh, that's the one you bought today. So yeah, it looks like if that's true, where you bought it for $1,000 and you sold it for 2,500, or somewhere near that, then yeah, these options may be more what we'd be looking to expect from a rise in volatility. And if that translates into better option premiums, not only when we get in, but a bigger profit on the way out, then this could be. Plus, it's leveraged, so it's a ultra. It's an ultra. So that could be something to consider. UVXY when building future hedges, because that would actually hedge certainly more than the VIX did this time around. So if you bought $1,000 worth of VIX call spreads, you'd only be up $470 right now, right? But if you bought $1,000 of UVXY, that's double. I don't even know if it's double or triple leveraged. Um, I don't know if this is. It probably won't even say it here, but if this is double or triple leverage, then you're going to have 2 to 3 times the reward potential. So this looks like it's probably also using VIX futures as its um, underlying tracking mechanism. And I say that because this thing has a NAV erosion that I believe is because anytime you roll futures forward, so when futures expire and you roll them to the next month or series of futures contracts, there is a little bit of a cost of carry, which can have more of a downward trending volatility. Um, and to reboot, what am I saying here? A downward trend versus the VIX that's just sideways, right? So this has a downward trend because of that NAV erosion. The fund seeks to track 1.5 the daily performance of the S&P VIX short-term futures index. Yeah, so it's using futures. So every time they roll those forward, you're going to have a little bit of cost of carry, and that's what causes this little bit of erosion here. But what is interesting, and somewhat probably concerning for long positions, is that this has been trending lower, but the momentum has actually been picking up to the upside. So we may see some more upside volatility potentially. If this is right, if this ends up playing out, we may see some more upside on VIX, which would mean downside in indexes, potentially. And right now with the S&P futures, After hours were a little bit lower than where we closed this afternoon. We do have some minor small time frame demand just sitting below. Otherwise, there's nothing stopping it from getting down to this 64.56 to 65.35 area, other than, a tweet, or there's no economic reports coming out right now, so none of that, or something out of the Fed. I mean, the news keeps bringing up. This morning, it was AI rejuvenation first thing in the morning. And then on the fall, it was regional bank stocks in trouble. Okay, I get that, right? So I don't know. Sometimes I think the news just kind of talks just to hear themselves talk. But I took down this symbol, this ticker symbol, UVXY, Ariel, so that we can start to track, because we may just abandon using the VIX altogether, and jump over to something else. And if UVXY is it, we'll join you. So appreciate that, Ariel. All right. See no more questions in the chat box yet. What else you guys got? Is it something you'd want to hold for a few months? I mean, if we were pretending to buy this now and we wanted to hedge all the way out to December, the options are liquid enough. And I'm guessing that if we were to, I don't know, 14 by 20, let's just look at that, 14 by 19. Let's do a $5 wide spread just to kind of see what's going on here. Here's something I don't get. This does not make sense. Which is several things that don't make sense. ES is linked to symbol 1. I go to analyze. That should say ES, but it doesn't. Why? UNG, UNG. All right, so now let's go back to UVXY. Analyze. There we are. Okay. Here's something I don't get. Unless it's just an after hours thing. But anytime you buy a at the money option and you sell an out of the money option against it, your at the money option is going to have greater negative theta. Your out of the money option is going to have smaller positive theta. So the net should still be negative. However, you build this position right now, and the graph shows that. So the risk profile in red here is your real-time risk profile. UVXY goes up, you go into profit. UVXY goes down, you're in loss, right? And here's the current price. But here's the weird part. Could be just an after hours thing. If UVXY parks itself at 1360 from here to expiration, this red line is going to evolve down over time over here, and it's going to evolve up over time over here, depending upon which side of this inflection point the price of the stock is. So we should be in a negative theta environment right now, right? Because every day it's going to evolve downward over here. However, this says it's positive theta. That makes no sense at all, unless it's just an after hours miscalculation. I mean, this should be positive vega and this should be negative theta, but that's reversed. I don't understand that. I'll have to look at this when the market's actually open to see if I can make sense of that. Because, we're on today's date. I don't think this changes anything. Nope. That's just the expiration date. That's strange. That we're getting a different reading here than we are here. So I'll have to check that out a little bit more. They all show a negative on your side, Ariel, or where? Well, what expiration are you? Are you talking about? I'm out here in December. I was talking about. So yours show all. So ours are showing different calculations. 14 by 19 December. Oh, the option chain. I don't have. Let me pull that up over here. Let's pull our. Yeah. Yeah. Theta is always going to show negative. Is that what you're talking about? And Vega will always show positive. Is that what you're talking about? So theta in the option chain will always be negative. Always. Why? Because all of these options are losing value over time. All of them. Now, when you buy one, you get negative theta. But if you sell this one, it turns your theta on that option to positive. But because this one is more negative than this one, which I'm not sure why this one's priced at a higher theta than this one. That's why it's pricing positive here. That one I can't understand. That makes no sense. Like for all of these thetas on these further out of the money calls to be greater than an at the money call makes no sense. That's not normal. So it could be an after hours thing. Yeah, that's never the case. Yeah, it could be because the market's closed. Yeah, the out of the money options and the in the money options should always have lower theta than the at the money because the at the money has the most extrinsic value. Unless, hang on a second. Unless no, even that's not the case. This is not making any sense. Because this one's going to cost you 252 in extrinsic value. That's the mid price. This one's going to bring in $1.67. So 100%, this one has more value to lose than this one. So you have to be positive theta. But I think it's just an aftermarket, just not calculating correctly. Check out October 17th. What do we find up here? Yeah, that makes sense. That makes a lot more sense. That's normal. About November. Not normal. Not normal. October 24th. Not normal. Yeah, so something's going on with this pricing calculator in here. Must be an after hours thing. Ryan asks, what are the differences between hedging using VIX versus buying a put, say on SPY or Qs? Cost of doing business is a bit different. If we're going with UVXY, you can buy the shares outright for 13.75. You can trade an option on it. If we did 14 by 19, you're trading that for $100, right? Just from a cost perspective. If you go over to SPY, this is a $660 position. If you were to go out to December, these options are going to be far more expensive, but more tied to the entire stock market as an S&P. So a lot of times it's a cost thing. Because if we were to go, let's see, if we were to hedge on the outlook that SPY would fall, say, to 608. right? 608 as a for instance. That would be roughly an 8% drop. I'm not saying it's going to do that, but let's say it did that. And then UVXY. In fact, I want to go back to that for a second. SPY. When did it last? When was the last there? June 25th, roughly. So June 25th is back here. So we're talking about a VIX rally or UVXY somewhere around here, right? So 14 to 22 almost. So if you were to try to say, let me buy some 14s, sell some 22s, $1.33. SPY, if we were to buy the at the money 660 and sell the 608s, on the put side, 660, 610, that'll cost you 10 times more money. Now you get 26 delta, negative delta. UVXY, you get 21 positive delta. So for the same rough deltas, you'll spend 10 times less money on something like this than you would SPY. That's probably the biggest reason I could think of. Right? So that's about it. You buy 10 contracts, right? You spend about $1,000 getting 200 delta. Be curious what the see what you get for your money over here. So if you spent, now you do make more money on the SPY. What would you say about make about $2,300 on SPY if it drops? Oh, I'm sorry. If it drops to 607. Let's go 607. So you make about $1,700 using SPY, right? UVXY, you'd make about 6,600. So it's not that different in terms of profit potential. Why does that keep doing that? Why that keeps doing that? 2175. Actually, it is. So this will make you 1,700 for 1,000. That's a big difference. The SPY would make you about 1,700 for same price. So yeah, it is about the same. So it's no different. It's no different. Not really. So if one is more liquid, which the SPY is definitely very liquid. That's what I'm looking for. Open interest has tens and tens of thousands of contracts. UVXY has thousands of contracts. So spread width is a big deal. So here's another reason, right? It's another thing to consider. If the market were open right now and these spreads, the bid-ask spread was this wide, right? 325 by 350 is a 25-cent wide spread. $1.89 by 220 is a 30-cent wide spread. Those are pretty wide spreads, right? SPY, being as liquid as it is, the 660s have a nickel wide spread, and the 610s have roughly a nickel wide spread. So spread width, you go SPY. If UVXY had this wide of spreads, while the market was open. So those are two big considerations. Good question, though. I love it. All right. All right. What else you guys got? What else do y'all got? Questions, comments, concerns? Ian, you're back. Nice to see you, buddy. Questions, comments, concerns, trades? Remember, it's your session, not mine. When you guys run out of questions, we go eat dinner. So Sip time. You guys can't be out of questions already, can you? What are options? Can like as far as like what are our choices? What are our like what could we do? Is that what you mean? Choices. Yeah. So were you assigned? So I was assigned shares of Alaska today. Today? Yeah, today. Were you assigned on them? Because I'm short the 55s. Price didn't hold that level, came screaming down. It had a rough day today, likely mostly due to United Airlines. They posted earnings, and I don't know. I know on Thinkorswim what UAL had it said is we're looking to make 27. We're looking to make we're expecting to make 263. We actually made 278, so that's better than United's expectations, but I don't know what analysts had predicted. That doesn't say that here. So UAL was down 5.5% today. It was down more intraday, came off of its lows when it hit this little pivot right here. So I think ALK, suffered, today. Not only it's been suffering on its own, but when you get the sympathy suffer because UAL is down. I wonder when DAL. Nope, Delta's already announced. Southwest is announcing soon. JetBlue is announcing soon. But AOK. So we're assigned on these shares. So really the only choice, because we have monthly options, no weekly options. If we did have weekly options, I would have looked to have maybe sold a covered call or used a stock repair strategy to get this 55 break even down, right? If we had weekly options. But we don't. We have monthly options. So our only choices are close the position just before, let's see. So on the 23rd, nope. When's actual earnings? Earnings are on the 23rd. Yeah. So close the stock positions on the 23rd if you don't want to hold through earnings. If you don't mind holding through earnings, then you could either just hold and see what happens, or you could sell a $55 call against it. Right now, the November, because the October is not giving you any premium. But if you wanted to sell a $55 call against it, you'll probably get somewhere in the middle around $1.05. So I was looking at a little bit earlier. That brings in over, well, roughly 2% return on your cost for 36 days, right? Risk is hold through earnings and price gaps down. You're going to lose more on the shares than you'll make on the calls. If price goes nowhere and it just stays below 55 all month, you'll get to keep the $1.05, and that lowers your cost basis to 53.95 because 55 is the cost. If you subtract the $1.05 because you get the credit, it brings your break even down $1.05. And the more calls you write, the more that brings your cost basis down. The other option could be, and I think we could pull it off, if you are willing to hold through earnings, is a stock repair. So what's a stock repair? Well, a stock repair involves us selling lower strike calls. So 5250 is lower than we own the stock, right? So if we sold, I own 300 shares here. So if we sold 3, our risk profile would look like this. Right? Risk profile would look like this, which means no matter what, we are going to guarantee a loss of $379 no matter how high the stock goes. Well, I'm not interested in that, right? I'm interested in break even or better. So what we'll do is we'll sell 6 calls against 300 shares of stock. Now, that by itself looks scary, right? Because it says, well, best case scenario, I lose 2 grand. Worst case scenario, no matter if the stock drops or goes up, we lose a lot more. Why? Because we have 3. I think it's in this account. Yep. Nope, not in that account. It's in this one. We have 300 long shares but we're 6 contracts short. Okay. Yeah, come on in, buddy. Turn the. Sorry, my son came in the room. Say hi.
Hi.
He came in the studio to grab cables. It's like Guitar Center in here. So we're naked on 3 of them. And by the way, this is in an IRA for me, so I couldn't sell 6 calls against 300 shares of stock. This, you'll see here, would be deemed illegal, right? I can't sell 600 shares worth of obligation and only own 300 shares. Can't do that. So why are we selling 6 calls then? Well, because what we're doing is we're trying to get our break even down. And so what we do for the 3 naked calls we have here is we buy 3 50 calls. Okay. Now I'm going to combine those two. Now you'll see what the risk profile looks like. It gets us pretty much break even, right? If the stock is anywhere above our new break even price. What do you mean new break even price? So there's some after hours stuff going on that's weird because this should look like a actual covered call, but it doesn't. It's a covered call. I'll show you what it should look like. I don't know why it's not looking like this. I think there's some weird after hours stuff going on. 2, 3, 1, 2, 3, 4, 5, 6, right? And that should bring in a credit of $67. So that $67 is a credit to your account. So if the stock stays below 52.50, even further, if it stays below 50, then all of this expires worthless and we keep 67 cents in credit, which is a little over 1% return on risk because we bought the shares for 55. If we get 67 cents credit, and we divide that by our $55 cost basis, that's 1.2% return on risk. And that's fine. I'll take 1% for the month or more on a covered call, but this is not a standard covered call. And again, I'm not exactly sure why because this should look like after hours. This should look like this, right? And this would show a profit. Oops. Of $67 per contract times 3. This should show a $201 max profit potential, roughly, if the stock is above 52.50. So what this does is it brings in a credit. We have 3 contract bull call spread in here, bull call spread, and we have a 3 contract covered call combined. And so what that does is that brings down the break even or your actual exit price down to $52. So if the stock is above 52.50, the stock is above 52.50, we can get out, sell our 300 shares of stock for a $2.50 loss. So that's what would happen because I own 55, I had to sell it for $52.50. So I'd sell the stock for a $2.50 loss, but this bull call spread, 50 to 52.50, we own 3 of them. Those are going to be worth a maximum of $2.50 each, right? And because we're getting a credit for the entire position, that means that we get all $2.50 in our pocket. We get to keep all $2.50 if the stock is above 52.50, which now we profit $2.50 on the bull call spread while we lost $2.50 on the covered call. That nets out to 0, right? No money made, no money lost. But because we get a 67-cent credit, we get to keep that too. So that's where the other $201 comes in. To me, that's a little bit of a better scenario because it lowers the price at which the stock needs to be trading at in November for us to be able to get out of this position for better than break even. So I like this option. Right, I'll make that purple actually. Actually, I'll make that orange. That's our short option. Purple is where we own it now. Yay. So here's where we have to get out if we do nothing, 55. If we did a 50 by 52 stock repair, the price has to be above 52.50. and then we can get out for a $200 profit, right? So I like, if we're going to do anything and hold over earnings, that's probably what I would do. How about a collar or convert to in the money put spread? So you can convert it to a put spread. There's a potential for assignment risk, obviously. So if you convert to a put spread, so sell the shares, right? Is that what you're talking about? And now do say, let's say, I wonder if you could do 52.50 by 50, get $1.80 credit. How much would you lose on the shares? You would lose, I'm down 2 grand on that, on the shares. Is that right? Yeah, 2 grand on the shares. 2,100, that is. So if I'm trying to make any of that up, I'm gonna need to do like 13 contracts here, right? Let's see what that would look like. And that would certainly add $900 worth of risk, but we're already at risk because we own the shares. And that will bring in $2,300 in credit. Now, the stock has to be above 52.50, but if the stock is back above 52.50, we make 2,300 when this stock position, if we were to sell it right now, would be down 2,100, 2,200. So we net out about $100 profit. And this isn't a bad idea either. You're doing a lot of contracts, but you are, it's not too bad. You're adding $900 more worth of risk if the stock drops, right? Because now you're in that new credit spread. But because it's an in the money put spread, the stock price still has to move. But if it moves up above 52.50 by, on or after November 21st, then yeah, 13 contracts will bring back in the 2 grand lost on the shares. So it's not a bad option either, actually, because by doing the stock repair, let's make that custom, and let's do 1, 2, 3. Oh, custom. 1, 2, 3 by 6, 67-cent credit. You'll notice that with the stock repair, the downside risk is still substantial, right? You got no protection on the downside. So yeah, this in the money vertical spread protects your downside while still giving you the chance to see if the stock can make it back above. It's adding $900 more worth of risk, which is not terrible, actually, compared to having all the downside risk of a stock repair. Yeah, I actually don't hate that. That's what the stock repair should look like. See how it's got this little bump right here, and now we have $201 worth of profit if the stock is above 52.51. The downside of a stock repair is and always will be that you still have downside risk if the stock drops further. So that's where this trade, sell the stock, take the $2,200 loss, collect $2,300 in premium for a credit spread. Stock still needs above 52.50. If it doesn't, you're adding another $900 in risk, which actually, now that we're contrasting and comparing the two, that's not terrible. The other option would be sell the 55s. I mean, you're making a collar out of it. Take your long stock position and make it look like that, like a bull call spread. So you're locking in a guarantee of 37.80, worst case scenario if it drops. But I don't like this as much because you don't have any upside profit potential. Best you're going to do is break even. So out of the three, I think stock repair, or actually probably a little bit more. I like your idea of the in the money put spread, because the holding over earnings is not for the faint of heart, right? Because all that downside risk, if this thing gaps down, would suck. So that's not terrible. Sell the stock, take the loss, sell the in the money put spread, or similarly buy the at the money call spread. That'll cost 93 cents. So your risk is 1,200. Stock still needs to be above 52.50. So you stand, yeah. So selling the in the money put spread is better than buying the same strike call spread, right? Basically the same trade. One's a debit, one's a credit. So between the two, the credit spread in the money is better than the call spread, the out of the money call spread. Same risk profile, but call spread costs you 1,200 bucks to make $2,000. So you're not covering your losses if the stock is above 52.50. You're not covering your losses here. Here on the same 13 contracts, you're risking $300 less than the call spread, right? 1209 versus 910. So $300 less, and you make $300 more. That would stand to be the case. So out of all three of these, I like your idea of the in the money put spread, sell the shares, realize that loss, sell the in the money put spread, and you could theoretically do that over and over if you needed to until the stock is eventually back above, and that would fix the problem, right? So yeah, that's good. That's good, Ken. I like that. I appreciate that comment there. Collar didn't make sense. Stock repair makes sense if you're okay with the downside risk. But the in the money put spread seems to be the best when comparing them all. So yeah, good, Ken. That's good thinking. Just trying to type and I can't seem to spell. All right. So what else y'all got? We're about 10 minutes away from the top of the hour. I do like these sessions because it yeah, things like this. It's like, what could we do? And then you guys have some suggestions, and I'm like, let's check it out, do the math. And all of a sudden we find something that's like, that's pretty cool, actually. I like that. So gives us stuff to think about when we get back into the market on Friday, or certainly before earnings. How do you see the market closing tomorrow? I know it's an impossible question, but what does your gut say? Well, we don't have any economic reports coming out at all. So nothing to stimulate that. NASDAQ's kind of in a minor, little uptrend here, but no real support. Each time this wick gets hit or this area gets hit, draw a box around it. So here's the low point. Here's the low point, right? So here we stopped going down, rally. Here we stopped going down, but we got deeper into that area. Here we stopped going down, but we got deeper into that area. So we keep getting lower every time. So I think if we do trade below 60, 2460, 641, it's not a lot stopping it from dropping to 24.5, ish. But we do keep coming down and hitting this little area that kind of feels like it's acting as some sort of support. But I think without any, honestly, we may do nothing tomorrow. Trying to bounce a little bit right now. I tend to be just in my own personal bias. I tend to be more optimistic, right? That the market overall likes to go up. It's designed to go up. I do know that. I do have kind of a perma bull, you know, feeling about the markets overall. But one of the partners at the fund is like a perma bear, always thinks the market should be going down, and fundamentally maybe should sometimes be going down. But I'm like, yeah, but the trend overall is still up. Look at the weekly trend, everything is still up. Oh no, that's not Chuck. That's John, one of the other partners. Not Chuck. Chuck's not a perma bear. John is though. But it's good because it's good to have those because we have conversations all the time. If we were all always perma bull, we'd get really caught, in the market. So it's John's perma bear, in his heart, in his gut, in his soul, that keeps us on our toes and saying when he's always bringing up negative delta positions. And sometimes the market just doesn't, or the portfolio doesn't even call for negative delta positions. So sometimes, we say, well, we get this whole conversation going on. It's just like, okay, more positive delta, because you're right, the trend is up. But when he brings up, some more negative delta positions and we start to really read into the charts a little bit deeper and he brings up the conversation, it's like, okay, I'm not totally bearish on the market. But your concerns are valid, and this does make sense to maybe start thinking about some negative delta positions to hedge against the portfolio. For instance, one of the things that he is a lot more in favor of, and I am as well, these days, is when we sell a naked put, if the price of the stock goes up, that's helping. In the past, I would always just close the naked put and
Sticking up.
I don't have them. I don't have any. We would just close the naked put and say, remove the positive delta so that we don't have any of that positive delta to weigh down the portfolio. But instead, what we've been doing is we've been flipping that positive delta position. Instead of buying the put back for 90% of the profit potential, like we normally do, we would be willing to spend an extra 10%. So now for 80% of the profit potential, we convert that positive delta position into negative delta. So we did that with APA, actually, in the Wealth Essentials room. So the original trade was this. We sold the 20 puts on APA. Let's go back to an hourly daily chart. We sold the 20 puts and prices shot straight up. And all of a sudden, we could buy back the 20 puts for 3 or 4 cents. But instead of buying them back and removing positive delta, we bought the next strike higher with the same 3, 4. In this case, we spent 5 cents, so we spent a little bit more. But now we're buying a higher strike put. We're still short the 20 puts down below, but we're using the money that we made here. So we made 32 cents on this option by buying these options for a nickel. So the best we can do is 32 cents in credit. But what we did is we actually lock in the guarantee. This is 10 contracts, so it's $320, $32 contract. And what we've done is we've converted this from a positive delta position, right? Very positive delta, to a negative delta position. So we've, instead of removing positive delta for about the same price, about a nickel, we flipped positive delta to negative delta. So now we have a hedge and we didn't even have to really pay for it. So the more we can, if we're still selling naked puts sometimes, right? The more we can free roll those naked puts into bear put spreads, now we're stacking up negative delta on positions that we're guaranteed to profit on. But in the event that the market falls apart, we now can make more money on these positions. And that made the most sense because of where APA was when we added the free roll. So when we added the free roll, price was right up against this supply here, this resistance to the left. And ever since, price has fallen. And so that's good. So now if price goes below 20, we actually want the price to go below 20 because right now we're guaranteed to make 320. Right now, we're guaranteed to make 320. We cannot lose it because we've made 37, we've collected 37 cents on these 20 puts. We bought the 2050s for a nickel, and now we're guaranteed to make $32 a contract times 10 contracts. But if APA falls below 20, we stand to make $820. That's 2.5 times more money than we're guaranteed to make. So now we, not on the whole stock market because our whole portfolio isn't this. I think we have about 5 or 6 of these on that we've been able to get into right now. So now we've got negative delta positions across a number of what used to be naked put positions, positive delta. Now they're negative delta. So we're balancing the positive delta with some negative delta, and this becomes very, I mean, it's free. We're going to buy these back for 4 cents anyway. So why not spend an extra, why not spend an extra penny to get insurance versus spend a penny less and just get out? Does that make sense, Ariel? And it's not even like an inverse BFF because it's still only a vertical spread, right? It's not like it's not like we, sold a put and bought a call spread or sold a call and bought a put spread. We're literally just turning this from a short put into a vertical bear put. And to turn that into a vertical bear put, we have to spend a nickel. But like I said, we were going to spend 4 cents to close the trade anyway, so why not spend a penny more and have some upside potential if this stock drops? Now, this is an October 17th expiration, so we got into this free roll, I don't know, was it about a week or two ago? So we don't have a lot of time insurance-wise. However, like what I've been doing, and this was one of the other members in the trading room, has started to get on this bandwagon of selling not front month options, so not 30, 40 days or less, but now we're looking at December, January options because you get a higher delta. You need less of a move to get to your profit target that you would make in a 1 month period of time. And so we've got 5 free rolls right now in the fund, for instance, one of which expires tomorrow, right? So we locked in guaranteed profit for that, but had prices have fallen sharply, quickly, we would have potentially made more money here. The other 4, one of them expires in November and the others expire in December. So essentially what we have right now is we have 3 hedges that were basically free all the way out to December, one that is a hedge out to November, and one that expires tomorrow. And so we're just converting positive delta into negative delta, which I enjoy much more than spending money on hedges. This, I don't really look at it as we're spending money, right? As a matter of fact, you look at nope. Here we go. So here's our free rolls. Well, I can probably show you a little bit easier on here. So here's the free rolls that we have open right now, right? APA is one of them. So here's our tracking sheet. So guaranteed, we make this money on these positions. It's already locked in. Okay. However, the profit potential, if the stocks drop below the original short put, which is a big move, right? Then we guaranteed 16,000 on these 5 positions. But if we're lucky on these positions and everything falls apart and the stock price goes back below the short put, we stand to make 36,000 on those 5 positions, right? One of them is a index, USO, XOP, APA expires tomorrow, and Ethereum, right? And you might say, well, don't bet against crypto. And I don't disagree. Don't bet against crypto necessarily. But we basically got in here, we got for what is it? So for USO, we got 86 days worth of insurance on oil for $5 a day. We got 92 days worth of insurance, downside negative delta, for $6 a day on Russell 2000. Now, APA cost us $24. We only had 23 days worth of insurance, but so that's about as expensive as we're willing to pay. We got $6 a day worth of insurance for 56 days of negative delta on XOP, Rocket and Ethereum. Actually, Rocket, that was anticipated. That didn't actually happen. Ethereum is one we got it for $9 a day worth of insurance for 74 days of downside insurance. Right? So over this period of time, if any of those markets fall sharply, or all of them fall sharply, which would be, awesome, then we convert what is a guaranteed 16, no, where did it go? 16,000 in reward to 36,000 in reward. So it doubles the reward potential by converting from naked put to free roll. Right. So with this all started because I'm a perma bull and he's a perma bear. So we've come to this agreement now that if we can free roll any of our short puts, we will always do it versus just closing, because it satisfies his perma bear, by having some negative delta in the portfolio. And I love having some balanced, portfolio delta as well for downside moves. So this is kind of the way that we've been leaning towards that kind of stuff. That makes sense. So it's literally just, notice I only went one strike up, right? It's the most cost effective if you're short the 20s to go to the very next strike, because you'll get that one for pretty cheap. If you're short the 20s and you try to go to the 25s, you're going to pay a lot more than you received for the 20s, right? So we want to pay a lot less. We want to take, if we were going to buy these 20s back for 4 cents, right, which is roughly 90% of 37 cents collected, then we would be willing to pay up to 8 cents. So instead of closing for 90%, we'd be looking to free roll for 80%. And that to us is like a no-brainer. If we can free roll for 80% or less of max profit potential, we'll do it. And your best chance of doing so is to buy the very next strike price above the one that you're short, because that's what's going to get you the cheapest. You follow all that, Ariel? Awesome. Yeah, it's pretty awesome. All right. Now I will say one thing before we wrap up our session here. Most of these free rolls have not paid off, meaning stock market didn't crash, the free roll didn't pay off, but that's okay because we're guaranteed, our money anyway. So we're just like, okay, we have some negative delta, doesn't really cost us anything. So, but most of them don't amount to, profit because the market doesn't crash down. In fact, if you look at this free roll spreadsheet and we open this up to all the closed positions, you can see we've got a number of them in here. But yeah, most of them, we've had a couple of them pay off. I need to update this spreadsheet to show realized P&L on this sheet because it's on another sheet. We got a lot of sheets. And this one, we haven't made any modifications to since we've created it. So that actually reminds me. Let me make a note. Here we go. Okay. So of course you want to buy insurance, but you don't want to use it. That's true. Right? And again, it's not like I'm not really doing anything different. Like I said, I'd be buying these back for 4 cents anyway. So why not pay 5 or 6 or 7 cents to flip it versus just close it? Because if you close it, yeah, you remove positive delta. That's fine. but you don't have any insurance for the other positive delta positions that you're in. This offsets positive delta because you actually converted it to negative delta, which in the fund lowers our VAR, which is our value at risk. So when you have some positive delta, some negative delta, you lower your VAR, which is a measurement of risk in the fund. So much more enjoyable doing this, even if they never pay off. Even if the free roll never pays off, it's cheap insurance, right? Which is great. And if the free roll doesn't pay off, it means the rest of your portfolio is probably doing fine. So I think we got on this conversation because John's a perma bear and I'm a perma bull, and this is how we satisfy each other's, so we play well together, right? We play well together. All right. It would be nice if we could just be objective and say, I'm not a perma bull, I'm not a perma bear. I just do what the chart tells us, but I don't know. I don't know if any of us, if we're really being honest with ourselves, I think we all probably have an overarching bias about the stock market. Right. Guy I used to manage the fund 4 years ago, perma bear, thought everything was going to crash all the time. And I'm like, all right, no, it's not. So I'll tell you, it's not. You keep throwing money at positions that are all bearish and you're losing on all of them. When are you going to stop? Right. So it's a happy medium here. All right. So there wouldn't be a market if we all thought the same way. That's true, Ariel. We can't always think the same way. That's why we have a market. For every buyer, there's a sell. Well, not for every buyer, there's a seller, but for every person out there that thinks the market should be going up, there's definitely another person out there that thinks the market should be going down. And neither of them are necessarily wrong, especially if they're considering, because I think most of the time we're considering the healthiness of the economy, how the Fed is looking at interest rates and inflation and, just everything related to the fundamentals, which how do we know that any of that's true anyway? You know what I mean? So, but we all have a little bit of a bias in us. So if we could balance that bias with some positive and negative delta in the portfolio, then I think that's the best case scenario. So I think my prediction is we close higher tomorrow. I don't know if that's my bias, could be, but I also see that every day we've been flip-flopping. Green, red, green, red, green, red, 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 2 days in a row. Green, red. This one should be green. Right. And that would be encouraging to see a positive close at the end of a week on a Friday going into a weekend. That would be, a little bit more of a bullish signal in my mind. Even though I don't think we're going to get to all-time highs necessarily anytime soon, not until we start getting economic reports flowing again when the government shutdown is over. So who knows how long that's going to be. I think we're just going to stay in a range here for a little while until somebody tweets something, Fed says something, does something, doesn't do something. I think all eyes are on inflation at this point. And then, like I said, there was some news out about I didn't dig into it. And by the way, look at these charts on FinViz, right? So just a quick glance, right? Drop, rally, drop, double bottom here on the Dow. We take out that high, we're closing positive. The momentum has already shifted up on NASDAQ. Same with the S&P. It's pretty flat, double. So I think we're double bottoming here on these charts. So I do think that, barring no major news or anything like that, I think that the market should close positive tomorrow. Diamond needs to shut his mouth. I mean, such a manipulative human regarding stocks. He says something bad is going to happen and everything sells off, and then he just gobbles all that buy. He just gobbles up everybody selling. Just gobbles it all up. I'll buy it. I just told him to buy it. I just told him to sell it, so I'm going to buy it. So regional bank worries. I don't know if I can. Regional banks. Signs, disclosed bad loans. That's not good news. Sparked worries about loose lending practices. Come on. We've always had loose lending practices. Subprime loans, those still exist. Come on, we should have learned our lesson there, right? So if these guys are still writing the subprime loans, then yeah, good luck. So we'll see. A lot of the big financial companies, certainly the JP Morgans, the Goldman Sachs, the Citi, Wells Fargo, Bank of America, those guys already came out with earnings and they were all great, right? So I don't know if those guys are into the shenanigans that some of these regional banks are in. But, anything to spark fear to get people to sell so that, those same banks can come in and buy. That's kind of how I look at that. So we'll see, right? I'll tell you, it's either going to close higher or lower tomorrow. But if I had a gun to my head and someone said, pick one, I'd say probably higher. Probably higher. All right. We are 13 minutes past the top of the hour. It's kind of a quiet night. You guys were awful quiet, but you had some good questions in. We had some good conversations, I think. So I appreciate you guys hanging out with me on this Thursday night. Stocks on the Rocks. If you need anything, shoot us an email, text. All of our contact information is on the website, TradersArmy.com. And I will do one final, just in case. I mean, we might have some people in here that are not members currently or watching back. But we have one little shameless plug here, and that is at Traders Army. What we do is largely membership based, right? So membership based, meaning it's a subscription model. So you can enter and cancel on a monthly basis. So you're not locked into anything. So we have an on-demand only subscription where you can get access to over 50 hours of all of our on-demand content. In the pro membership, you get all the same access to all the on-demand content, plus the Options Deconstructed series, Wealth Essentials Model Portfolio Tracker, and 8 live trading rooms every week for under $5 a day. Now, first month, everybody gets a little bit of a break. So if you use the promo code I'm going to type this. I don't know what I'm doing, trying to write that out with a mouse. Trader60 as a promo code when you go to check out on the month-to-month pro membership specifically. You'll get 60% off the pro membership for your first month. After that, if you maintain your membership, it's $149 a month. Again, less than $5 a day, which is cheaper than your Starbucks habit, probably. But that's my shameless plug of the evening. Trader60 promo code first month 60% off. So if you have any questions about what we do, how we do it, if you're brand new to Traders Army or you're just watching back and saying, hey, maybe I'll check it out, but I have a few questions, shoot me an email. You can text us up here as the phone number in the top left-hand corner. You can send an email to support@tradersarmy.com. That's support@tradersarmy.com. And yeah, we'll get you set up, answer your questions. If it's a good fit, great. If it's not, it's not, right? No hard feelings. But keep coming back to Stocks on the Rocks. That's every other Thursday. Same time, same channel. I hugged the mic. I'm sorry. What do you mean you hugged the mic? You're like giving me a hug? All right. Cool, Ariel. I talk too much. Oh, no, you hogged the mic, not hugged the mic. No, you didn't actually. No. I mean, the questions came in kind of slow. I kind of had to like pull some stuff out a little bit. Normally the questions, I can't even hardly get to them all. So kind of a quiet night. But so listen, we want to spend the whole hour talking about stuff. You talk about whatever you want to talk about. I don't care who talks, as long as somebody talks. All right. So appreciate that, Ariel. Thank you. So let me know if you need anything. Herman will see you guys who are members in the futures trading room tomorrow, and I will see you on Monday in the options trading room. Have a good weekend if I don't hear from you. We'll talk to you soon, you guys. Bye now.